$19 trillion, that's 19 million, has been wiped off global stock markets since the highs of a year ago, much of it in the past week. And if you're wondering how that might affect you, consider this. That figure of 19 trillion is 5 trillion more than the entire US economy is worth. It's 2 trillion more than the European Union, which is the world's biggest trading bloc. And get this, in the past year, it's the equivalent of 1/3 of the world's entire economy being lost. So big numbers, and the impact is huge. It's not just about banks and stock markets, it's about people's jobs, their homes and their life savings. So where will it all end? Over the past few hours, central banks around the world have injected another $360 billion to prop up the markets. Half of that is a credit line in cash from the US Federal Reserve. We'll be talking to a leading world financial expert in a moment. But first, Harry Fawcett on another devastating day for global markets.
The ripples of another doom-laden day on Wall Street took just a few short hours to engulf the Asian markets. Hong Kong's Hang Seng was worst affected, losing more than 7% of its value around the midpoint of the trading day before regaining those losses towards the close. Tokyo's Nikkei closed 2.2% down at a 3-year low. Bad enough for the government to plough another $14.5 billion into the system, while admitting that the forces at work seemed beyond its control.
As a non-professional, I see the current market movements as completely unrelated to the basics of the Japanese economy. So what I can say is that the Japanese market's rise and fall cannot be explained only by what is happening here.
And so a global crisis requiring a global response. As the European markets opened, the central banks of the US, Europe, Britain, Canada and Switzerland announced a coordinated arrangement of currency swaps and credit lines, all designed to get more money into the system and stop the selling.
With no money in the money market, basically the financial system will come to a halt. That's why the central bank acted immediately and provided liquidity to the money market. If nobody else, if commercial banks are not ready to lend money to other commercial banks, the central banks will.
It represents a step up in the level of intervention, but so far intervention hasn't stemmed the bleeding. Even the US government's drastic rescue of the insurance giant AIG, not enough for Wall Street, where the Dow Jones finished 4% or 449 points down at a new 3-year low. All eyes now on the next institution to fall. So those institutions are looking for a life raft. Both Morgan Stanley and Washington Mutual said to be trying to sell themselves off.
Types of tie-ups that are being looked at just in the last 3 to 4 hours. I mean, Morgan Stanley with Wachovia, Morgan Stanley maybe with CITIC. I mean, this, if you mentioned this to someone or you predicted this to someone 6 months ago, they would have said you were crazy. But now it seems as though anything's possible.
Even deals that would once have been ruled illegal on competition grounds. Britain's biggest mortgage lender, Halifax Bank of Scotland, swallowed up in a $22 billion deal on Thursday by the 4th biggest, Lloyds TSB, after days of heavy falls in HBOS's shares. Banks, investors, governments, all scrambling to keep up with the crisis, moving at breakneck speed. Harry Fawcett, Al Jazeera.